know and love and live, you're going to have a tough time in the market and probably not a very good career. Those two words are respect risk.
Hmm.
So you have to respect risk at all times. And again, like I said, after a while, you have success and you start getting sloppy and you think it's easy. And that's when things can go really, really bad. You get your biggest or your worst beatings come after your biggest successes. So that's when you really got to get your guard up.
Hmm. And in terms of cutting losses, what is it that you do to make sure you're always minimizing your risk? I mean, a lot of people look at, you know, ways in which they reduce risk by, oh, I'm not going to trade right before earnings, or I'm not going to, be buying, breakouts because breakouts are failing. What is your best way of reducing risk? And I know you've wrote a couple books on this, so it's not something you're necessarily going to be able to say in a few words, but anything that sticks out to you?
Well, I mean, as far as reducing risk is concerned, I'm always losses are a function of expected gain. So I'm always trying to get a handle on what I can expect on the upside. So, for instance, in this most recent period, my upside has been a lot less because
Hmm.
stocks are just not giving us that upside. So
Right.
now I've got to make up for that. I've got to now truncate or shorten my losses to make up for that. So I'm always measuring what I'm pulling out of the market on average on the gain side.
Hmm.
And then I don't want to risk any more than I want to have a 2 to 1. So I
Hmm.
want to be risking 50 cents for a dollar. I prefer even I'd like to have a 3 to 1. That's what I'm really shooting for. But at a bare minimum, I want a 2 to 1. So if I'm pulling 8% out of the market, I can't take 8% losses. The 8% max stop rule is going to be off the table at that time. And I'm going to have to average less than that. If I'm averaging 8%, and even if I'm right, 50, let's say 50% of the time. Now, if I'm right less than 50% of the time, this is a period where I'll bet most of the viewers here, if they went back and they looked at their trading in the last 6 or 8 months, I'll bet you their batting average is really low. Even if you're maintaining that ratio and you're
Right.
cutting your losses in relation to your gains, it's probably a period where your batting average is low and probably in the 30s. And that's because of the whipsaw. That's the whipsaw
Hmm.
environment. Which the other thing about managing risk is you have to realize that people think a bear market is it's dangerous to go into a correction. Actually, no. The sideways market is the
Right.
most dangerous market for a breakout trader that uses tight stops, because that's where you get whipped in and out, and you get death by 1,000 cuts. When you roll over, you go into a bear market, everything stops you out, nothing sets up, and that's it. You're in cash. That's we'd love to have it where the market rolls over, knocks you out everything, and then has a big correction. That would make it real easy. But it's these whipsaw markets that are really the ones that you have to survive. And what I do is, if things aren't working in those, and if my trading's not working and I'm not producing profits, I sit out and I wait it out. And I'll go in with little pilot buys and just keep my finger on the pulse
Right.
and put my toe in the water until that's working. I don't get aggressive. I never get aggressive until I'm having those pilot buys and those smaller buys work. And then I'll start increasing my exposure. So one of the things about managing risk is to work with profits. And before
Hmm.
you get aggressive, if you're not profitable at 25%, there's no reason to go to 50% exposure. If you're not profitable at 50% exposure, there's no reason to go to 75 or 100. There's no intelligent reason whatsoever to be raising your exposure when you're not profitable. And one of the ways to look at that is to just look at your last 5 trades. Have your last 5 trades made money on balance? And if not, maybe you try another 4 or 5 trades. Have those trades made money on balance? If your answer is no, and you came into the market a couple times and took 3, 4, 5 trades, and you're not making money, then right there, that gives you all the information you need to know about whether things are working or not, and you should be getting aggressive.
But another thing that I think is interesting about the math involved, and there is some math here, that you have those ratios of your risk reward set up to such a point where you can be wrong a lot and still make a fortune. So how is it that you do that? And maybe share some statistics, because I think people would be surprised with how many losing trades you can have and still come out so far ahead.
Yeah, I have lots of losing trades, only but my losses are very small in relation to my gains.
Right.
So as far as the math is concerned, and we talked about this a little bit earlier. What I did back when I first started trading, I wanted to figure out how all the trading rules, and I went to O'Neill seminars and so forth, and even David Ryan, who now trains with me at the Master Trader Program. I was going to see David Ryan 30 years ago and learning. But once I got that and I started understanding how to apply the buy rules and the stop losses, I wanted to really dig in and get behind the actual mathematics of it. And I started using a lot of techniques or a lot of an approach like futures traders did, where they really got mathematical about it. And I just started getting obsessed with my statistics and measuring everything. How many days I hold my winners, how many days I hold my losers, what's my maximum drawdown, what's my, what's my average drawdown from peak, what I'm giving, that's my give back, what my average gain is, my average loss, my ratio adjusted for batting average, all the statistics. And I just started, what happened is as I started trading, I realized that when you do that, it makes its way into your trading. Now, I'll give you an example. This is like really key. Once you start doing your numbers and you're aware, so let's just say you've done your average, you know what your average gain is. You look at your last 100 trades, your average gain is 8.9%, let's say. Okay, so now you're in there, you're making a trade, stock starts going against you. It's down 4%, it's down 5%, it's down 6%. You know, the little bell that goes off in your head, you start thinking, wow, my average gain is 8.9. I can't let this trade go bigger than 8.9 or I'm losing. Right. And that's if you're right 50% of the time. So, and if you're having trouble and your batting average is lower than that, that number is even lower. So now you're thinking, you're trading and you're thinking based on the math. You're letting the math come into your trading and you have this awareness and it improves your trading. And that's where things really started to change for me, where I started making decisions. All my decisions became mathematical decisions. Just like in a poker game, you've got $50 into the pot. You don't bet $500 into a $50 pot. Now you're laying 10-1 odds. But if there was a $500 pot and you bet $50 in it, now you're getting 10-1 odds. So you have to always be thinking risk versus reward. And the main rule that I have is always get odds on your money.
One thing is, and you started the whole episode out with